Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. There's a ton going on in the economy, and obviously we're interested in what real estate investors think about that. Today we'll talk to a gentleman that was a congressman for 4 years before becoming the director of the Office of Management and Budget under President Ronald Reagan. He's a guy worth listening to today on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. In the co-host seat, it's our financial strategist, Russell Gray.
Hey, Robert.
We love real estate, talking real estate, looking at real estate, buying real estate, and especially owning real estate. As you know, if you listen to the program, we also are big fans of stepping back and looking at the bigger economic picture. Because if we get too focused on real estate and not pay attention to what's going on in the rest of the world, we absolutely miss some super important stuff.
Well, you say it all the time in one of your seminar jokes, which is, you know why God created the weather? It's so complete strangers would have something to talk about. Yep. But the reality is the economy, the financial system, the ecosystem of finance and commerce is something that we all have in common. And it's something whether you invest in mobile home parks, self-storage, you flip, you save, you buy apartment buildings, medical office buildings, do ground-up development, doesn't matter. We're all operating in this system. And a big part of what we depend upon is the stability of the currency. We definitely all use debt to one degree or another, and interest rates and the availability and health of credit markets is a real important factor. And there's things that occur in the financial system. Obviously, we just saw with Silicon Valley Bank, there were things in the financial system because of rising interest rates destroying bond values. And then a little trigger came along where the folks at Silicon Valley Bank got nervous, started withdrawing their deposits. And now all of a sudden you've got the biggest bank failure since Washington Mutual in the great financial crisis. And the Fed is stepping up and the whole world is paying attention. And you say, well, could anybody have seen that coming? And the short answer is yes. And so that's why we talk about these things. And when we have the opportunity, as we do today, to snag an interview with some of the smartest people in the world, we do it. We ask them questions and we let them talk because they have a lot more to say about the matter than we are. And then, as is custom on the back end, we do a little bit of interpretation and say, well, what does all that macro stuff mean to Main Street?
Our guest today was a congressman for the great state of Michigan. He went on from that job to a post under Ronald Reagan. He was the director of the Office of Management and Budget in the early 80s White House. We had a chance to meet him a few years back, and it was a great time to get around a super smart guy. We're thrilled today to welcome back David Stockman to the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Self-storage is an asset class that has stood the test of time. Going into the Great Recession of 2008, self-storage had the least negative impact of any of its commercial real estate peers, and it had explosive growth coming out of that time during the recovery. Fast forward to 2020, and you'll see that same pattern during some of the worst part of the pandemic. Hi, my name is Dave Zook, founder and CEO of The Real Asset Investor. Our operating partners are some of the best in the business, and we've had great success over the last decade buying mom-and-pop operated self-storage facilities and taking them to the next level by forcing value through increasing the square footage, adding climate-controlled units, bringing in our professional management teams, and turning the project into an institutional target. We have self-storage investment opportunities available for accredited investors who are interested in investing in this space for cash flow, tax impact, and huge equity appreciation. Reach out to us today at selfstorage@realestateguysradio.com.
Hey, this is John Asseroff, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 27th year of broadcast. Thanks for tuning in. You picked a great show because we have a great guest. In fact, we first met our guest several years back at a live event in Manhattan, and we went up to get our gigantic book signed. He has a book that is heavy, thorough, and very eye-opening. And he was kind enough to invite us to his apartment where we conducted an interview. And oh my gosh, what a wealth of history and wisdom and legacy. Of course, a lot has happened since then, so it's time we got him back on the show. Please welcome the amazing David Stockman. Hey, David.
Glad to be back, and you're right about a lot of things have transpired, and I think most of them haven't been very good. So the worrisome trends that we talked about 4 years ago, maybe it was, or 5, I think are coming to fruition. That's why I might just say in starting here that I put a book out last fall called The Great Money Bubble, Beware of the Coming Inflation Storm. Well, I think the inflation storm is here, and it's created all kinds of problems in terms of the Fed and Washington and where the economy's going that are going to be very difficult to cope with.
Well, I think you're right, David. And one of the things I love about the book is it's pretty simple. You definitely share your opinions, but you've kind of earned the right to have those opinions. Now, we've given the audience a little bit about your background before you came on. You know, last time we talked about things like inflation and where the economy was going. Since then, we've dealt with transitory inflation. And of course, that's turned into permanent inflation. It's higher than anyone wants to admit. Now we've got failing banks. We've got ripples in the commercial real estate market. What do you make of all this?
You know, I think we're just drifting down the road to a dead end, and we do it in increments. And every time there is some kind of upheaval or warning sign, they find some way to paper it over. They get out the bubble gum and baling wire and somehow stabilize the system. And then we go on to a new higher level of basic instability, imbalance, malinvestment, whatever words that you want. But let's just quickly repeat it. When the great financial crisis hit in September 2008, the balance sheet of the Fed was about $900 billion. By the time they thought they got the problem solved and things stabilized, and Bernanke said, well, we're now going to eventually bring the balance sheet back to where it was, the balance sheet was $4.4 trillion. But instead of then aggressively undertaking what they promised to do, and that was to shrink the balance sheet back to something normal, drain all this excess liquidity out of the system, you know, they played Mickey Mouse with it. Then we had the repo, upheaval in September 2019, and they started up the printing presses again. At that point, the balance sheet was $3.8 trillion. Then came along the COVID disruption, and they really went to town. And by the peak last year, the balance sheet was up to $9 trillion. So here we are in a period which isn't that long in real time, the fall of 2008 to the present time. Call it 14 years. The balance sheet of the Fed went from $900 billion to $9 trillion. Okay, that's a 10x gain during a period of time in which the GDP didn't even double. So the obvious point is, where did all of that fiat credit, and that's what the balance sheet represents, money snatched from nothing by the Federal Reserve, injected into the financial system through the bonds and bills and notes that it buys. But where did all of that go? Well, basically, it drastically inflated almost everything in our economy. Eventually, it started on asset inflation in Wall Street. It spilled over into a lot of different sectors of real estate, unfortunately. And then in the process, one of the things that got inflated badly was commercial bank balance sheets, an issue that we were reminded about in the last 2 weeks. If we go back again to the 2008 starting point, commercial banks saw their balance sheets or their deposit base grow at 7.5% a year. during a period of time when nominal GDP grew by only 3.9%. Now, how did that happen? How did you get, this is small banks, but overall, the banking system overall was 6.5%. But my point was, how did you get deposits growing at almost double the rate of GDP when logic would tell you that if the savings rate didn't change, which it certainly didn't get better, that deposits in the banking system would grow at about the rate of GDP, savings would grow about the rate of GDP, but instead it doubled. Well, that's because the Fed drove money market interest rates to the zero bound, and money had nowhere to go. T-bills paid nothing. Short-term commercial paper, money markets paid practically nothing because the Fed forced rates to an absurd point. Zero interest is absurd no matter how you parse it, how you slice it. It never should have happened because in the economic world, money, even overnight money or 3-month or 9-month money, has to have a price. That's the nature of things. But in any event, they flooded the banking system with all of these cheap deposits. Deposits went from 7 trillion to 18 trillion. The banks didn't know what to do with the deposits, but it was a go-go time. The stock market was booming. Bank executives figured out that they could make a bundle on their stock options if they could just crank up their so-called interest margin, that is what they make on the assets versus what they pay on these dirt cheap deposits. They could live happily ever after. And so what they began to do was drastically mismatch their asset liability books. Now, it wasn't just on the credit side, which bankers have been doing from time immemorial, by investing in risky assets, funding them with essentially hot overnight money. But they also got convinced by the regulators that, a wonderful thing is long-term treasury and agency securities because they're risk-free. Well, how did they know they're risk-free? Because the new regulations under Dodd-Frank said you don't need any capital backing federal securities, treasury securities, because they're essentially risk-free. So what they did was created a duration mismatch. They bought the 10 years, the 20 years, the 30 years, the mortgage-backed, long-term mortgage-backed securities, were booking 3%, even more on their assets and paying less than 1% on their liabilities because the Fed had forced overnight money to the floorboard, as I say. Now, that made for a lot of phony bank profits. I mean, it wasn't fraudulent. They were using proper accounting, but it wasn't sustainable, is my point. They basically were getting money at a deeply subsidized rate that couldn't last, that at some point the Fed would have to face reality and begin to aggressively raise interest rates as goods and services inflation gradually out of control. Well, that's where we stepped in last March 2022. During the course of the last year, they've had to raise interest rates 400 basis points, and that threw the whole wonderful party that had been created in the banking sector into a cocked hat. Open market interest rates are now back up to 4.5%, 5%. People don't have to keep their money in no interest deposit accounts, checking and savings accounts. So money is now fleeing the deposit base, and you have bankers who are extended high and dry because they mismatch their duration. And we're going to find out as we get into the recession ahead, which I think is unavoidable, that they have got a lot of credit risk lurking in their books that didn't seem like a risk when interest rates were at rock bottom, but will end up being very risky and therefore prone to loss as the economy goes down for the account and interest rates per force are pushed back up into something that's normal by a Federal Reserve that's way behind the curve and is desperately trying to bring inflation to heel. So that is a huge mess. It took years and years of big mistakes and really stupid economics, if I could put it that way, to bring about. But lo and behold, here we are. And so again, what do you have? Well, they're at it again. A weekend panic scramble in Washington. And, they come up with a bailout for $150 billion of non-insured depositors at SVB, the Silicon Valley Bank, including, some depositors with 10, 50, $100 million deposits who were the big boys of Silicon Valley, the venture capital world, and all the go-go startups. Well, what in the world sense does it make to bail out all those depositors when they knew that these deposits were not insured, when Congress had up to 40 years to insure large deposits if they wanted to, because we've had problems in the banking system ever since the savings and loan crisis in the late 80s, but Congress never agreed to raise the limit above the 250,000. They never were willing, for good reason, to embrace 100% deposit insurance, because talk about moral hazard, you can't really think of anything worse. And yet here we are with a weekend crisis, panic in the system, the same old cries about contagion and financial instability, leading Washington to bail out the most undeserving players in our entire financial system. Now, I'm not mentioning all this just to, beat on the carcass of all those alleged financial geniuses in Silicon Valley that had their money in the SVB. What I'm getting at is, if we're at that kind of desperate point where you knowingly feel and I'm talking about Washington now, feel that you have to bail out billionaire venture capitalists, we're in a pretty bad way. And I think, the idea that this was some kind of one-off, some kind of aberration, it was, one of a kind, is so wrong. It was a product of the very bad monetary and fiscal policies of the last decade. And as they always say about cockroaches, where you find one, you're going to find a lot more crawling down in the underbrush. And that's where I think we are today. And I think that's an important starting point for people thinking about new investments or existing investments, or, trying to judge the stock market or bonds and fixed income securities and real estate, which prices off from them. You have to recognize that we're in a state of the economy where the cockroaches are just beginning to be flushed out, and there are going to be more of them. Those create these flare-ups of panic and selling pressure, and it's not going to go away. There's going to be more and more to come until this thing really blows its top, so to speak.
Well, and I think if, most of our listeners, probably like us, got letters from a lot of their bankers saying, hey, what happened over there, that's not how we do things. We're a lot more sound and so forth. But I'm glad you've covered a good deal of the history here, because so many folks are saying, well, this is a recent phenomenon, right? We look at the inversion of the yield curve and look what's happened recently. And certainly raising the rates has triggered a lot of this.
Yeah.
But as you've said for a long time, this problem didn't start when the rates started to go up. This problem started on the other end when we got away from quote unquote normal rates. And you mentioned that today too, getting back to normal rates. I think we've got listeners that have only been investing in the last 5, 6, 8 years. They probably don't even have a reference for what a normal interest rate is like.
Yeah. That's such a great point. And that's why, to be a little bit provocative, I guess, I often say the Fed isn't raising rates, it's normalizing rates, because the villain of the piece is not that the funds rate today, I think, is trading at 4.9%. There's nothing wrong with that. The villain of the piece was that it was trading at 0.5% barely a year ago.
Right.
And that was distorting the whole system. And what we're actually doing now is normalizing. But what I think people who may have not been in the system that long, and I've been around it for quite a while, I go all the way back to 1970 when I started on Capitol Hill as a young staffer. But any event, what people need to recognize is that inflation has never been successfully curtailed by a central bank when interest rates were still negative in real terms, that is, after inflation. So now ask yourself, where do we sit this very day when the benchmark rate, the Fed's target rate that it sort of drives or tries to drive the whole system with, is at 4.9%? Well, no matter how you slice the inflation rate, year over year, 6 months trailing, 3 months trailing, there's a lot of different ways to look at it. I like the 16% trim mean CPI because it takes out all the high and low outliers, but they're different ones every month. And so therefore, what you basically do is smooth the trend of everything that's in the basket, which is a lot more accurate and a lot more representative than this, CPI less food, energy, shelter, and a whole bunch of other things they take out until you don't have anything left. But anyway, what I'm getting at is if we look at that 16% trim mean CPI, the year over year is 6.7%. The trailing 3 and 6 months is in the 6.1, 6.3% range. And even the February annualized rate is up well above 6%. Now, let's just say that that's a reasonable measure of the running inflation rate. And the Fed is at 4.9, that's at 6.5. You got 1.5 points of negative interest rate in the money market and even larger gaps in the term market, that is, treasury notes and longer term securities. Now, if you have negative real rates of 1.5 to 2%, the Fed is not nearly done with its inflation fighting, even though everybody would like to believe that they're going to pivot any day now. I say no. And I actually have the experience of having been around in the late 70s, early 80s. I was a budget director, obviously, in 1981, when Volcker was fighting, taking on the battle of the same high and persistent inflation that we have today. Now, when he took over the job, he was, Jimmy Carter wasn't very happy about putting him in. But in August 1979, things were getting desperate, and so he put in Volcker in. The real Fed funds rate was 1.5% negative, same place it is today. But in the next 12, 15 months, Volcker raised the real rate to +8, +9% by pushing the nominal rate into double-digit area. And it was that switch from negative real interest rates, which just fuel inflation and keep the speculation and the excess leverage going, when he pushed real rates up into strong positive territory, the back of inflation was broken. By 83, 84, it was down to 3%. And fell even under that as the decade progressed. Now, that's a good history lesson because I think it should be a kind of a warning that they're not going to tame inflation with, stopping at 5.1%. You turn on bubble vision and you've got 15 talking heads in any given hour who will tell you that the last rate increase is coming in May And then in September, we're going to be cutting again. I say no way. I say that the Fed is going to have to get rates substantially into real positive territory. It's going to take a lot more than 5%. And inflation is a lot stickier than even some of the bullish Wall Street people were saying even a few months ago. So if inflation is sticky, the only way you get the real rate positive is to push nominal rates far higher than today. 7%, maybe 8% could happen. Now, the problem is our economy is far more fragile today, our financial system, enormously more fragile than it was back in 1980-81, last time Volcker had to take on a serious embedded, accelerating inflation. And I think one way to measure that is every time we've had one of these start-stop bailouts, paper over the thing, what I call the baling wire and bubblegum treatment, it has been accomplished by just injecting more debt into the economy. Now, and I don't mean just government debt. I'm talking about everything. Households, we get households to borrow one way or another with ultra low rates. Businesses are supposed to be borrowing in order to invest, although they mainly use the proceeds to buy back their own stock, which is essentially a form of speculation. So each time we resolve the breakdown with more debt relative to income. Now, if we look at it in the great sweep of history, which of course Wall Street never does, and the Fed, has got like a 1 month focus or a 1 year focus at best. They're as bad as kids in junior high school. But in any event, if we look at 1980, the debt to GDP ratio was 1.6 times 160%. And that had been pretty much the norm for decades and decades, really going back to the 19th century. That was reasonably compatible with shutting down the inflationary cycle and getting the economy back on its feet, which it did, and we had the so-called Reagan boom. But today, that same ratio I'm talking about, total debt, household, business, government, and finance, is $94 trillion. It represents 3.6 times GDP, not 1.6.
Wow.
And while that may sound like a picayunish point in some sense, for people in finance, we know that 2 turns of income, more of debt, is a big thing. When you go from 1.6 turns on income to 3.6 turns on income, you've had a fundamental structural change. Now, what does this mean in round numbers? Well, it means that if we still had been somewhat prudent over the last 40 years, the Volcker debt to GDP ratio at 1.6 times would mean the debt on the U.S. economy today, public and private, would be $42 trillion. But as I said, it's actually $94 trillion. So what I would suggest to people is that the elephant in the room, the gargantuan financial elephant in the room, is 50 trillion of excess debt, or 52 trillion to get the math precise, of excess debt compared to what we had relative to income at the time that Volcker, brought the hammer down on inflation. Now, why is this important? Well, it's important because the 50 trillion of excess debt sitting on the economy means that every 1% increase in interest rates on average across the board, because they're going to add it to your credit card. Once you refinance your mortgage, you're going to be paying, it eventually works its way into the system. 1% more of interest at the Volcker debt level and leverage ratio would be $420 billion. But at the current debt and leverage ratio, it's $950 billion. So when we look at the stock of debt, we got 50 trillion more relative to income. And we look at the flow of debt service costs, we're getting $500 billion more for every single 1 percentage point of interest rate that the Fed reluctantly is allowing to happen. And it's going to take a lot more than 1% additional percent from where we are today. So I think those are some of the numbers that give us a kind of range finder. You know, where are we in the scheme of things?
Yeah.
Where are we in the flow of historical economics? Well, we're in a pretty bad place where we've got the 50 trillion burden and where we have a Fed who has only one tool. You know, they're like the one tool carpenter where everything looks like a nail because his only tool is a hammer, right?
Yep.
Well, the Fed is a one-tool central bank. It can raise interest rates. That's about all it can do. Its credibility is totally shot and on the line, and the public is not happy whatsoever with 6% inflation when, you know, the food part of it is in double digits and energy is still way higher than it was 2 years ago. So the Fed is going to have no choice but to keep hitting the nail with its interest rate hammer. And in an economy with this much debt, the furniture that they're going to break will be astonishing, far, far more extensive than some of the very tough time that some people may remember from way back when Volcker, Paul Volcker went through this cycle back in the early 80s. So again, it's not something that's transitory. It's not something that's 3 months from turning the corner. It's not something where the Fed is on the road to victory over inflation. None of those things are an accurate characterization of where we stand. The Fed is on a road to an economic dislocation of huge magnitude, and it doesn't really know how to avoid it or how to stop. And I think that's the key proposition of the moment. It doesn't know how to avoid the carnage that lies ahead, and it doesn't know how to stop given the momentum that is built into the inflation that we're now, struggling with.
Our guest today is David Stockman. His latest book is called The Great Money Bubble, but there's more. The subtitle, Protect Yourself from the Coming Inflation Storm. We'll talk about some of the ways that we can weather that storm when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hear ye, hear ye. Registration is open for the Real Estate Guys 21st Annual Investors Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year is the editor of the Gold newsletter, Brian London, real estate developers Beth Clifford and Victor Monash, and Jim Rohn's 18-year business partner, Kyle Wilson. Also back, the rebel capitalist George Gammon. And joining us live and in person for his 11th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet. It all begins June 6th in beautiful Ambergris Caye, Belize. Visit Summit on Sand to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to summitonsand.com and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 21st Annual Investors Summit on Sand.
Hi, everyone. This is Jim Rickers, the author of The New Case for Gold, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, there's just a few spots left at the 21st Annual Investors Summit on the Sand. It's going to be extraordinary. Spending more than a week delving into many of the issues we're talking about today and even more. We've got Kenny McElroy coming back with us, one of the all-time great real estate investors and syndicators. Self-taught economist George Gammon is joining us for his third year. Real estate developer, host of the Real Estate Espresso podcast, Victor Menashe. Real estate developer Beth Clifford. Editor of the Gold newsletter, Brian London. And Jim Rohn's 18-year business partner, Kyle Wilson, will all be there, plus lots more and a couple of cool surprises. Grab one of the last remaining spots by sending an email to summit@realestateguysradio.com, summit@realestateguysradio.com. We're talking with David Stockman today and talk about a guy that's got a bunch of history and perspective. Before we get back to that interview, it is time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com, trivia@realestateguysradio.com. You'll need to include your name, the answer to the question, and your physical mailing address so that we can send you this awesome prize. It's called Resilience, turning your setback into a comeback. Stories of overcoming adversity and failing forward. That can be yours if you know today's real estate trivia question. Last week on the program, we were talking about underwriting and due diligence with Brad Sumrock, and we asked this: which U.S. state has the most current job openings? Well, a lot of talk about low unemployment, but according to commodity.com, as of January 2023, the state with the most job openings is Alaska, with an average rate of 9%, followed by Hawaii at 8.6% and Montana with 8.37%. Now you know where you need to go if you need a job. Here's our real estate trivia question for this week. Speaking of jobs, Americans do a whole bunch of different things. So, of the American workforce, what's the number one category of jobs? Yeah, the thing that most people do, or at least more than any other category of vocation. If you think you know, or maybe you work in one of those jobs, send your best guess to trivia@realestateguysradio.com. That's trivia@realestateguysradio.com. Include your name, the answer to the question, and your physical mailing address, so that if you're the winner, we can send you this awesome book, Resilience, Turning Your Setback into a Comeback. That's today's real estate trivia question. We're talking today about the great money bubble, and there's no doubt that everyone has felt the inflation. Our guest, David Stockman, has been watching this for a long, long time. And David, what's unique about your position is obviously you were on the government side of things for quite some time. You were in the private practice part for quite some time. And now, of course, at the Contra Corner blog, you're writing about this stuff all the time. You contribute a lot of material. You're out there a ton, sounding the alarm, but also talking about the things that can be done. You know, in the early 80s, you know, you were working with President Ronald Reagan. That seems like forever ago, but you were pretty young when you started in your political career. How much have things changed as far as that part of it goes, politics and the economy?
I think three things have changed. Obviously, politics have gotten a lot more partisan, but the Capitol Hill contingent, both Republicans and Democrats, have gotten a lot more relaxed about public debt and deficits. You know, the big problem we had in 1981 is they thought the tax cut was going to create too much deficit. And we had a lot of politicians, including in the Republican Party, opposed to cutting taxes for their constituencies for fear that it would lead to more public debt. Well, that's all gone now. Okay.
Right.
The second thing that has changed is that back then, Volcker was at the Fed, and he was one of the greatest Fed chairmen of all times, but he wasn't totally an aberration. In other words, the central bank back in 1980, not for a moment would have thought about 120 billion a month of bond buying, even in the equivalent dollars of that time.
Yeah.
It would have been unthinkable. Or to take its balance sheet, as I said before, from 900 billion to 9 trillion in, barely a decade, a little over a decade. So what is big difference is that we've gone through 40 years of progressive deterioration of both fiscal and monetary policy. And in some sense, they were symbiotic. The Fed felt that it needed to accommodate all the Treasury borrowing on the one hand, inappropriately. They monetized huge amounts of the debt. And on the other hand, the politicians no longer feared rising deficits and debt because the Fed was keeping interest rates artificially low. Back in the day, in the early 80s, we constantly talked about crowding out and the effect of Treasury borrowing, deficit borrowing, on interest rates. Because if the Fed wasn't monetizing the debt and the supply of savings in the short run doesn't change very much, then when the Treasury got its big fat arms into the bond pits and pulled away huge amounts of available savings, well, obviously it pushed interest rates up. And the next thing you knew, and I was a congressman from a typical kind of town and country district. I had small manufacturers and farmers and everybody in between. But before you knew it, you were hearing from back home about rising interest rates. Car dealers complained because financing their product became much more expensive. Manufacturers got upset because they couldn't borrow for capital spending. Homeowners got upset because mortgage rates became prohibitive and so forth.
Yep.
So there was a feedback mechanism. Borrow a lot at the fiscal trough. Private borrowers get crowded out. Interest rates get pushed up. The public reacts. Messages come back to Washington saying, get your fiscal house in order. And the thing was somewhat self-disciplining. It wasn't perfect. And, there was a drift over time to more and more debt, but at least there was a feedback mechanism. Well, what has changed enormously since then is the post-Greenspan Fed, which basically assumed that it could print money with impunity, and that if doing so resulted in monetization of large chunks of the federal debt, so be it. If doing so resulted in artificially and ultra-low interest rates that encouraged the politicians to spend more and borrow more and, let the fiscal issue be pushed off till tomorrow, well, then that's what we need to do in order to carry out our mission of what I call Keynesian growth, jobs, and inflation goals. So that is a big, giant change, and it led to a cumulative deterioration of financial discipline and financial stability in the system, and led to this fragility, that we've been talking about. We have $92 trillion of debt on the total economy. Now, I just want to, I'm not like... who's the guy in the Old Testament who lived for 900 years? I forget his name right now.
Methuselah.
I'm not that old, but when I was in the White House, the total debt on the U.S. economy, public and private, was $5 trillion. It's now $92 trillion. And the GDP back then was, 3 or 4 trillion, and it has increased since then, but nothing like the order of magnitude that has happened with the debt. So as we said, there are 2 extra turns of debt on the economy, public and private, and that's a $50 trillion elephant that is at the heart of any accurate diagnosis of where the economy is today. You can't think about anything, interest rates, how long the inflation battle is going to last, PE multiples, cap rates for real estate projects, any of the financial ratios that are key to investment are influenced and impacted enormously by this extra 50 trillion of debt that we have on the economy. It basically circumscribes everybody's running room, everybody's runway, everybody's margin for error. There is much less margin for error in the system today than there was back then. And that's one of the reasons why, as recently as last fall, they were praising the Silicon Valley Bank as a great paragon of banking virtue. And then just out of the blue yonder, so to speak, the whole thing went up in smoke over a few months. Now, the warning signs were there for a lot of quarters and maybe even years. But the point is, the economy is so fragile today because of all this debt and all this deviation from what I would call fiscal rectitude and sound money, that we're prone to the kind of surprises that we've been getting more and more of late, and that crystallized 2 weekends ago when the whole small banking sector seemed like it was on the ragged edge.
Now, David, earlier you mentioned contagion, the idea that this would spread from bank to bank, and mostly that's because these banks do business with one another. But rather than dwell on that concept, we'll see what happens. What about a contagion, if you will, beyond the U.S.? We have the reserve currency, and yet the system is fragile. The balance sheet is tremendous. Yeah. We're starting to see cracks, around the world. How does what's happening here really interplay with what's happening in the rest of the world?
I think it's totally interactive, and it's a complete feedback loop. The economy has been totally globalized, both in the financial system, where trillions of dollars move every day in the currency exchange markets, for instance. It's obviously in the world trading system, where we have, I think there's something like 25 trillion of two-way trade. And it's in the global economy, which is 90 trillion big and represents a constant interchange of financial flows, capital flows, and goods and services. So the thing is totally interactive. That's the first point. The second point is that what the Fed has been doing has been basically mirrored by all the other major central banks of the world. In other words, one way to look at it is the Fed led a race to the monetary bottom, and everybody else tried to keep up with it. The ECB, the Bank of Japan, the People's Bank of China, the BOE, and you could go on to the lesser fries, because with the Fed flooding the global financial system with all this fiat credit, had others followed the tried and true, let's say, sober, sound money approach that investment bankers may have had, some decades ago, their exchange rates would have appreciated strongly against the dollar. And then their politicians would have been all over their back about you're killing our export industry, you're driving a business abroad. It's not an accurate analysis, but that's the dynamic that happens. The politicians would have been all over the central banks to ease up and follow the lead of the Fed. So basically what we have is a convoy of money printing central banks that stretches all the way around the globe, and that has basically flooded the global system with the same kind of excess central bank credit that I described for the Fed. And if you want a quantity on it, it's actually pretty shocking. But go back to 2003, 2004, when, this bubble was just beginning to build up a head of steam. We'd been through the dot-com crash, and Greenspan was now trying to cut rates dramatically and revive the economy. But anyway, if you look at the global situation in 2003, the balance sheet of the central banks was about $2 trillion. That is, you add up everything. The Fed, the ECB, and all the lesser fry, it was $2 trillion. Today, it's 45 trillion.
Wow.
Okay. The balance sheet of the central banks are 45 trillion today when you add them all up, including the huge 9 trillion balance sheet, or nearly 9 trillion of the Federal Reserve. So if the central banks of the world printed more than 40 trillion of new high-powered credit over the last 2 decades, then it is logical to assume, it's necessary to assume, that the same kind of bubbles and imbalances and excesses and reckless financial management that we have seen signs of recently in the U.S. economy is extant all around the world. And of course, last week we had Credit Suisse and, 11th hour bailout of that woe-begone institution by the Swiss central bank, its government, with a backstop from the ECB and the Fed. But, when you look at it, it shows you how crazy this is, because I am absolutely convinced that whatever good parts there were in the Credit Suisse, its banking franchise in Switzerland, some of its asset management divisions, could have easily been bought up after the fact, after a bankruptcy, by the healthy institutions that would have been interested. But instead, the central bank did what the Fed did back in 2008. They basically collared UBS and said, we're your regulator, and when we say jump, you say how high.
Yeah.
And in this case, they said, you're going to buy Credit Suisse, you're going to pay $3 billion. When they first said $1 billion, that didn't fly. You're going to pay $3 billion for it, and you're going to take on all of their assets and liabilities, but we'll give you a $9 billion loss protection safety net and a $100 billion liquidity line. So I was thinking about that. There are 8 million people in Switzerland.
Yeah.
Okay. So that amounts to $50 million of liquidity line per family. 50 million. I didn't say 50,000. I said 50 million. Okay. And if you look at the 9 billion loss corridor, that's about 4 or 5 million per family. Now, I've gone to Switzerland a lot. We vacation there sometimes. It's a very pleasant and prosperous country. But I never thought they were so rich that the average family could step up for a $50 million credit line, which the central bank. Now, I know it's a little bit absurd, but the point is it shows you, the situation around the world is probably in many ways worse than it is here. The debt ratios in Europe are worse than they are here. The debt ratios in Japan, are beyond even, measurement practically.
Right.
I sort of think of Japan as a bankrupt retirement colony because that's, basically what's happening. Their workforce is shrinking, their retired force is mushrooming, and they've got just incredible amounts of both public and private debt. In other words, as the condition in the U.S. unravels, it's not going to stop at the Atlantic and Pacific coast. It is going to tremendously and contemporaneously and instantly really spread through the international financial system, because the whole thing is so intricately connected.
Hey, David, near the end of your book, you do talk about some of the ways that people can think about protecting themselves against inflation. When inflation plods along at 2 or 3%, we don't really think much about it. But lately, more folks are thinking about this. Hey, before we get to that, though, I know that we've always thought and felt and taught that real estate can be a great hedge against inflation. It maintains its values and so forth. But I don't remember if it was in the book or in one of your articles where recently you said that may not always be the case. Can you speak to that?
Yeah, I'll try to do it very succinctly. And that is, this is not your grandfather's inflation. That was my proposition.
Yes.
And then if you go back to, say, 1968, before the great inflation of the 70s started, bond prices were pretty normal and pretty sustainable. And as a result of interest rates being positive and sustainable and normal, real estate, which prices off debt, as we all know, on the margin, was properly priced or, reasonably priced as you went into the inflation storm. So over the course of the 70s, real estate asset prices rose with the inflation, but it was properly priced going in. And so therefore, you were able to ride the storm and the inflation storm and actually maybe make a little bit if you were an astute, a picker of properties and you used a reasonable amount of debt.
Yep.
Now, the difference today, and it's not that I'm saying you don't invest in real estate, but the difference today is that we've had 40 years of financial distortion. We've had ultra low, absurdly low bond yields and bond prices. A year ago or so, remember the 10-year Treasury, which is really the benchmark cap rate for the entire real estate business at the end of the day. But the 10-year Treasury was trading at 1.5%, which is nuts. It's crazy when inflation was where it was then and certainly where it is now. So as a result of that, I think there was a systematic tendency over the last decade or two for real estate prices to be pushed higher and higher as interest rates were pushed to the floorboard by the Fed. And that's only normal because the signal the central bank was giving to the market was, load up on real estate assets, leverage them up with cheap debt, and, capture the upside over time and the spread in terms of current income and outgo. Now, the problem today is that as the Fed tries to bring inflation to heel, it must inexorably push interest rates higher. And that means the cap rates for interest rates are going to be impacted negatively and therefore pushed down. And therefore, real estate values will be under tremendous downward pressure as the interest rates normalize in the years ahead. Now, if you're totally in the income business, the income property business, and you're going to hold to maturity, so to speak, this isn't such a problem because you can raise your rents or at least maintain your rents, hopefully, and cover the cost of the debt. But if you're in the real estate investment business, where you bought at the top of the market on leverage and you were fixing to, cash in 4 or 5 years down the road, that's going to be a problem because the exit cap rate is going to be far lower as the Fed pushes interest rates back to normal than the entrance cap rate when these properties were bought in the last few years. So it's kind of a mixed picture. Income properties, if you can ride out the storm, should be reasonable investments if they're managed correctly and so forth. But if you're in the buy and flip business, I think this time, it's not going to be the kind of inflation hedge that it was during the 1970s.
Excellent. So then what are some of the things that folks should be thinking about if we know what's happening and where it's going and no one has a crystal ball, but to your point, the Fed only has one tool. What are some of the things that people can do to protect themselves?
Well, I think the big thing is to turn the balance sheet upside down compared to what people have been doing and appropriately so for the last several decades. In the last several decades, the route to higher net worth was to gather assets, accumulate assets at the most rapid rate possible, fund that expansion with low-cost debt, and build the difference, the net worth, through asset appreciation. The issue going forward is that asset prices are going to go down or flat at best, and the carry cost of the liabilities is going to go higher and higher, or the carry cost of refining your debt, if it becomes due, is going to be a lot higher than it was when you first took it on. And so therefore, the order of the day is you build net worth on the liability side, not on the asset side. That you build net worth by shrinking liabilities, not expanding assets, because you don't want to buy a wasting asset, something that's going to shrink in value over time. Now, that may sound a little kind of simplistic, but it's a totally different worldview than what people have had, than what has been the recipe for financial success during the last 30, 40 years of this super historical bubble. Now, how do you reduce debt? Well, there are a lot of ways. One, you don't spend as much, but that's not always possible, but it is at the end of the day.
Yeah.
But secondly, if you have assets that have appreciated quite handsomely, quite substantially, then before it's too late, it is a good idea to think about whether they should be cashed in and any parallel debt or debt on the balance sheet paid down. That's the name of the game going forward. Increasing cash flow to pay down debt, cashing out mature or highly valued, highly priced assets in order to pay down debt. That's the only thing you can do that will make a big difference on the bottom line, which is net worth, wealth, during a period in which the stock market is the financial markets, the casino, as I call it, is going to be a dangerous place to navigate unless you're, the smartest guy in the world and you can maneuver with great dexterity every 10 seconds, 24 hours a day. Well, there are very few people that could do that. So you need a new fundamental strategy, which is, again, the liability shrinking approach, rather than the asset gathering approach.
All right. Well, David is the author of several books. His most recent book is The Great Money Bubble. And if you're interested in that, plus the work he does on the Contra Corner blog, all you have to do is send an email to Stockman. That's his last name, Stockman, Stockman at realestateguysradio.com. You get a link to the books, I should say. And, talk about for just a second, as we wrap up here, David, what you do at the Contra Corner blog, because you're a prolific guy. You cover all kinds of things.
Yeah, I'm glad you asked that. David Stockman's Contra Corner is the name. I tend to publish about 5 days a week, except holidays every now and then.
Yep.
And I address a range of topics. I guess it's representative or reflective of my background. I spent half of my career in Washington on the government side and fiscal and monetary side, another half on Wall Street on the financial side. And for the last decade almost, I have been, a commentator, publishing analysis and data, dissecting trends and so forth based on those 50 years of experience on both ends of what I call the Acela corridor between Washington and Wall Street. So we cover what the central banks are doing. We cover the fiscal issues and the regulatory issues coming out of Congress. We look at financial trends in different sectors if things are hot, like I've been doing a lot of work on the small banking sector and what it portends. So it's very topical, but what's different is that I try to put what's happening today in much greater historical perspective than you're going to get in Yahoo Finance or the Wall Street Journal or any of the other, financial publications. You really have to have history. You really, I think, need to know the common sense point that we weren't born yesterday. A lot of what's happening today is a consequence of 10, 20, 50 year ago developments, and these need to be factored into the equation when we think about what's happening now and what may occur next.
Well, we love that, and we are sure appreciative of your time today. Great reconnecting with you. Thanks for being on the program, David.
Okay, very good. Very much enjoyed it.
There's David Stockman. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. There's still time to get your spot on the 21st Annual Investor Summit on the Sand. It happens in June in beautiful Belize. All the details on the website at realestateguysradio.com. You'll see the button that says Summit. Well, my goodness, I have the feeling we could go on for another couple of hours with David Stockman.
Well, it's really funny because how this interview came about is I was pursuing David to see if we could get him on the summit. But these are the types of conversations we like to have on the summit because, as you can tell, it's impossible to cover the topic in depth. There's so many things. His base of knowledge is so far above most folks. You've got to really be primed before you even get into the conversation. So if your head is spinning, let me just tell you, as a guy who knew nothing about this 15 years ago, it is possible to understand it. If you've been listening to the show for a while, you know, some of the things David talked about are many of the things we've been talking about. Part of that is because we've been studying him and other people like him. At the fundamental base of it is the financial system is made up of banks and credit markets, which are populated with bonds. And bonds derive their value as a derivative of interest rates. And when the Fed starts tweaking interest rates, it tweaks asset values. When rates go up, asset values go down. If you've noticed in the apartment space, that's what's happening. It's called cap rates going up, and that means asset values are going down unless rents are going up. And so when you understand that basic concept, then you can begin to see the stress that exists when David talks about the fragility of the financial system and the fact that these bonds are all over the globe and not just in the United States. You begin to understand how contagion can happen. And if contagion can go from the United States banking system to banks like Credit Suisse and Deutsche Bank, if it can create inflation globally, what can it do to you on Main Street? And so I applaud you for having stuck through this entire interview because David's a heady guy, and I would encourage you to continue your study. It's one of the reasons we have the Investor Mentoring Club, because Main Street investors cannot afford to be ignorant of the machinations of macro. I know because in 2008 I was ignorant of them, paid a price. We've made it our mission to help enlighten our audience. So if all that's interesting to you, make sure you send the email to Stockman at realestateguysradio.com and get that information. If you're really interested, send an email to Summit at realestateguysradio.com and be in Belize with us, because this is the kind of stuff we talk about with really, really smart people, and we have time to go deep. And then you might take a look at our Investor Mentoring Club by sending an email to IMC, like Investor Mentoring Club, at realestateguysradio.com, because this is the stuff we cover every month.
Big thanks to David Stockman. Again, if you're interested in his book and what he does on his blog, just send an email to Stockman at realestateguysradio.com. Next week, we'll talk Target Center real estate. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.